Walking into an office, doubling every employee's salary, and attracting thousands of new customers, only to have colleagues attempt to sabotage the progress, is the current reality for Caitlin Clark. For decades, the WNBA functioned as a league defined by its limitations. It struggled to sell out arenas, failed to turn a profit, and relied on annual financial support from the NBA to remain operational. This changed when Clark arrived from Iowa. Her long-range shooting and immediate impact generated unprecedented public interest. However, the response from within the league was often hostile, characterized by physical intimidation and veteran players suggesting she wait her turn. That period of transition has concluded, and the financial implications are becoming clear. By attempting to protect their seniority, veterans may have damaged the primary driver of their own financial future. The irony of the situation is evident. Diana Taurasi publicly warned that a difficult reality was coming for the rookie. Instead, that reality has arrived for the veterans. As NBC and Amazon commit billions to a new media rights deal, promotional focus has shifted away from the league's historical figures toward Clark. While foundational players continue to fly commercial or watch from home, Clark is positioned as the global face of the sport. The power shift occurred with such speed that the established guard has become largely secondary to the league's bottom line. The data confirms this shift. Prior to 2024, a successful broadcast for the WNBA averaged approximately 400,000 viewers. With the Indiana Fever, viewership has reached 2.4 million. Ticket prices in Indiana increased by 300%, and opposing teams have been forced to move games into larger NBA arenas to accommodate demand. While increased fan engagement typically leads to higher salaries and merchandise sales, the internal response was marked by visible friction. This included hard fouls from Chennedy Carter, Angel Reese celebrating flagrant penalties, and persistent claims that Clark's fame was merely a product of a media narrative. Corporate entities have responded by aligning with Clark. Brands such as State Farm and Wilson have built marketing ecosystems around her. Meanwhile, Nike, which sponsors many of the league's prominent veterans, reportedly bypassed a Super Bowl advertisement to avoid the internal politics of the old guard. This silence serves as a de facto admission regarding marketability. Posts featuring Clark generate 5 times the engagement of any other player. Subscriptions to streaming services like Peacock spike during her games and drop when she is on the bench. The league has reached a critical juncture. The Players Association is currently seeking a 30% revenue share and improved travel conditions. While these are standard demands, the veterans lack significant leverage. Team owners recognize that if a strike occurs, rosters can be replenished with collegiate talent. As long as Clark remains active, arenas stay full. By attempting to marginalize the league's most profitable asset, veteran players have weakened their own negotiating position. This situation serves as an objective lesson in sports business. The WNBA spent 25 years seeking this level of national attention, yet attempted to gatekeep it once it arrived. The industry has moved forward regardless. Broadcasters and owners are prioritizing ratings and fiscal reports over legacy or seniority. In professional sports, compensation is dictated by future viewership rather than past achievements. The efforts to impede Caitlin Clark effectively became a high-reach marketing campaign. Physical play and dismissive interviews only increased public support and viral engagement. The attempt to suppress her influence instead established her as the center of the league's economy. The WNBA no longer belongs to its legends. It belongs to the player who increased the league's valuation while letting the statistics and financial data speak for themselves. The trajectory of the league is now tied directly to these numbers. The financial restructuring of the WNBA is no longer a theoretical projection, it is an active market correction. In 2025, the league expanded its schedule and its reach, culminating in an economic impact that experts estimate at $1 billion. This surge is anchored by a media rights agreement with ESPN, NBC, and Amazon valued at $2.2 billion over 11 years. This deal represents a tenfold increase over the previous contract, fundamentally altering the valuation of every franchise in the league. For context, the Indiana Fever franchise value quadrupled in a single year. Road game ticket prices for the Fever spiked by 140%, and merchandise sales across the league rose by 500%. This influx of capital has triggered a high-stakes confrontation over the league's collective bargaining agreement. Players currently receive approximately 9.3% of league revenue, a figure that stands in stark contrast to the nearly 50% shared by NBA players. As the 2026 season approaches, the WNBA Players Association has pushed for a model that ties the salary cap directly to gross revenue growth. The league's counter-proposals have introduced the possibility of a $1 million base salary for elite players, with total compensation for top earners potentially exceeding $1.3 million through revenue sharing. By 2026, the average player salary is projected to surpass $500,000, while the league minimum is expected to rise from $67,000 to approximately $250,000. However, these negotiations have highlighted a growing rift between the league's established stars and its newest assets. Commissioner Kathy Engelbert reportedly noted that rookie players like Clark already generate upwards of $16 million in off-court endorsements, a figure that dwarfs the current league salary cap. This creates a unique tension. The veterans are negotiating for a larger share of a revenue pool that is largely being expanded by a handful of rookies. If the veterans choose to strike, they face a league that is rapidly expanding its footprint. The WNBA is moving toward an 18-team structure by 2030, with new franchises in San Francisco, Portland, Toronto, and Cleveland. These expansion fees have climbed to $250 million per team, signaling that investors are betting on the league's future growth rather than its historical performance. The commercial sector has already placed its bets. Nike's commitment to Clark includes an 8-year deal valued at $28 million, featuring a signature shoe line and a custom apparel collection. The release of the interlocking C logo in late 2025 served as a prelude to her first signature sneaker, scheduled for 2026. This level of investment is historically reserved for global icons and reflects a shift in how brands perceive the marketability of women's basketball. While veteran players have expressed frustration over the perceived lack of marketing support for their own achievements, the data remains uncompromising. Viewership for non-fever games has seen a respectable 15% increase, but games featuring Clark consistently draw audiences 4 to 5 times larger, often exceeding 2 million viewers. The entry of the Golden State Valkyries in 2025 further illustrated this new reality. As the first expansion team to play in 17 years, the Valkyries sold out every home game and became the first expansion franchise in WNBA history to make the postseason in its inaugural year. Their success was built on a $50 million expansion fee and the institutional support of the Golden State Warriors. In contrast, newer expansion fees for Detroit and Philadelphia have jumped to $250 million. This rapid appreciation of franchise values means the old guard is now operating within a business ecosystem that values growth potential over seniority. The current stalemate in labor negotiations underscores the lack of leverage held by the veterans. The league has proposed removing team-provided housing, a standard benefit for decades, arguing that higher salaries make such subsidies unnecessary. For established stars, this is a manageable shift. For the rank-and-file players, it represents a significant increase in the cost of living in expensive markets like New York or San Francisco. The league's willingness to cut these traditional benefits suggests a shift toward a more aggressive, traditional corporate sports model. Ultimately, the WNBA is transitioning from a subsidized venture into a primary commercial driver. The Caitlin Clark effect provided the initial momentum, but the subsequent $2.2 billion media deal and $250 million expansion fees have institutionalized that growth. The league is no longer asking for permission to exist, it is demanding a premium for its presence. The veterans who once carried the league through lean years now find themselves in a paradox. They are finally seeing the wealth they advocated for, but they are no longer the primary reason that wealth is being generated. As the 2026 season begins, the scoreboard that matters most is the one tracking ratings, revenue, and retention. In that arena, the data shows that the audience is not just watching basketball, they are watching a specific evolution of the sport that the traditional guard has struggled to contain.